Ladies and gentlemen, welcome to Creating Tailwinds Podcast by Flight Path Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Good morning, John. How are you, sir?
Good morning, Jared. A very good morning today.
Awesome day today. Another beautiful day with air in the lungs. Life is good.
Absolutely. It was cold last night. Did you see that?
Goodness.
We've got a thermometer outside the window. It was, I think, 25 degrees. 25 degrees in, south of Atlanta, Georgia. Holy cow. That was colder than Boston. I talked to my son this morning. It was colder than Boston. Boston was 30s.
The hard part there is what you put together, right? It's that cold is not normal, but that cold in Atlanta, holy cow. Everybody kind of freaks out a little bit. I was even outside making sure that the hose bibs had the little covers over top of it so we didn't freeze any pipes.
I know. I had to bring all Antoinette's plants in yesterday. All the plants came in so they didn't freeze. That was fine. It was fun. But my goodness. So, well, tell me, what's on your mind today? What are you thinking about? What should we talk about?
But the one that hits recent, there was just some news that was released from a couple of the companies that we work with. Typically on the infinite banking side, we're working with mutually owned life insurance companies. We typically steer clear from your par companies, right? Am I saying that right?
You are.
That's right. So without naming them by name, we won't call any of these specific insurance companies out. But there was some news released recently where one of them was talking about what their dividend was, that they increased their dividend, how many years they had paid it. And so that kind of put it in the forefront. I figured maybe we should just briefly talk about that, maybe some of the dividend options, some stuff that you've got once your policy's up and running.
Absolutely. And I think maybe we should set the table a little bit for everybody who might not know.
Yes.
Not all insurance policies pay a dividend. There are a lot of companies that provide death benefit. They may even have cash value, but they don't all provide a dividend. So you got to know. And then there's dividend paid on certain parts of the contract and not on others. So It just depends on the contract. It depends on the company. So know what you're getting. Just because somebody says, hey, you're getting a dividend with this. Well, am I getting a dividend on the whole thing? When does it begin? What are the criteria for getting that dividend? We look at that very, very carefully. So the companies that we use pay dividends on the whole darn thing. And regardless if you have a loan out, there are no restrictions on the usage of the loans collateralized against your cash value. You can have 100% of your loan against your cash values and still get 100% of the approved dividend for that given year. So that's important to know. That is a non-recourse loan. There are many that have recourse loans out there.
Yes.
And some would argue there's no. So some would argue that doesn't matter. Well, I think it does, and we could talk about that another time. But maybe we ought to hit the how a dividend is paid. What can you do with a dividend in the company that you're doing business with? In a mutual company, you own the company, right?
That's right.
So let's talk about
to reinforce what you're saying. Really well said there. I love that's the setting the table, right? Because not all the companies pay dividends. Not only that, but just like you said, not all the portion of it is going to receive the dividend on what you've built up. We talk about constantly building these assets, right? You're building lifelong assets that stay with you for a long time. If your goal is, the least amount of money for the most amount of coverage, you might want to look at a term product. This is not that. A term product typically does not carry cash value, is certainly not going to pay a dividend.
It's all death benefit. That's all you're buying for a very short space of time.
Correct. For something that hits a finite point of time and then falls off into nowhere land, and you have nothing to show for it. These are completely different, but these aren't as well known in the marketplace, right? You hear whole life and you're like, oh, Dave Ramsey poo-poos these. This must be a horrible product. Well, go find out for yourself. Maybe learn about it a little bit and see the asset that is built by paying premium.
And well, Dave Ramsey, don't want to spend any time on him, but he is certainly no authority on insurance. He is a
Yep.
phenomenal marketer.
Yes.
His company is worth, I don't know, a couple $100 million. He makes money off of publishing and selling his system, and he gets overrides on a lot of the things that he does. So
That's right.
I want to steer clear of Dave because I've got um, a poor taste in my mouth over his representations, which are incorrect on dividend paying whole life insurance. He doesn't know what he's not accurate. It's not right.
That's
And
fair.
Dave, if you're out there listening, feel free to put me on your show, and I'll be happy to debate you on the subject anytime. Enough said
That's right.
about Dave.
Fair. So maybe we'll come back to the recourse, non-recourse. I love the intro there. We can come back to that, but maybe some other, just making sure we're setting the framework as well. When you consider a whole life policy, when you get to the very last stage with John and I, one of the very last things we're going to do is put an illustration in front of you that shows a guaranteed and a non-guaranteed section. The
Absolutely.
guaranteed section of that contract says that when you sign that policy and you pay your premiums, you're guaranteed these columns. There's going to be a cash value, there's going to be a death benefit. Those are guaranteed contractually. The entire non-guaranteed section, the component of that is the variable, is the dividend, because
Correct.
they are not guaranteeing you that they will pay you a dividend. However, when that dividend does pay, there's some different options you've got. You can have, I like to turn it in the idea of plumbing, where it's like a faucet, right? You can turn the faucet off over here and turn it on over here.
Yes.
That's kind of the way that I visualize it. But there are some different options that you have with dividends, but all of that non-guaranteed side is based on your dividend. And it's non-guaranteed because they're not guaranteeing they'll pay you a dividend. Yet
Right.
one of the companies that we write with just announced their 121st year of dividends. A lot of these mutually owned companies are over 130 years of dividends. Now that doesn't mean it's a banner 10% year every year, right? It could be down into the fours, could be fives and sixes. Like,
Yes.
again, these are
Yes.
all non-guaranteed.
Correct. The important thing to remember, though, with these companies that have paid the dividends, everything, when you get your annual statement, that's a snapshot in time that is fixed. It cannot go down from there. Once a dividend is received, buys you additional death benefit, comes with additional cash value, that is locked in forever. You don't lose
That's
that
right.
ever. Unlike some of these other products, that is not the case.
That's
So
right.
your cash value, your premium, and your death benefit, those are the guarantees. That's the gold standard, and that's what you're getting with the products that we deal in. And so when we're building an infinite banking structured contract, and we're talking about dividends, uh, let's let's talk about what you can do with the dividends. All right, they'll give you, say it's a 5% dividend, they'll cut you a check and they'll send you a check for 5% for your dividend. And the important thing to remember is that's taxable because anytime money leaves the contract for good, like that in that form, that's a taxable event. And so it's
Yep.
important to understand the taxable consequences of how you treat your contract. You could keep it with the insurance company. They could pay the dividend, put it in a side account, and it'll earn interest. That interest, the gain, is taxable. So how can I do this without being taxed on it? There's a number of ways. You can do what we all encourage, and that's paid up additions. You buy additional, fully paid for life insurance, which comes with a death benefit and cash value. And so every year there's a step up basis. So, and every year on every one of the contracts we sell, there is a step up basis regardless of the dividend because there's a guaranteed interest component. It's not much. I mean, it might be 1%, but if a dividend is paid, once you realize that dividend, it steps up and you've got a new starting point on the guarantees. So your guarantees still come from that non or that guaranteed column, but the illustration is only as good as how long.
As literally the day you printed it.
Exactly right.
Yes,
So
that's right.
do not be deceived into thinking that, oh, I'm going to take this other contract and I'm going to have all this money in the future based on these projections. They are nothing more than projections. It's the guaranteed side that really, that's where the rubber meets the road.
That's fair.
So,
But if you look at a contract that's, let's say, 8 to 10 years down the road,
right.
each of those 8 to 10 years that they that they raise the bar, that they use that dividend to purchase PUAs as we would recommend, that they have raised the bar every single year. So when we talk about, we've used the word before, uninterrupted compound growth. That's where that comes from. Every time you raise the bar, you set that bar higher and it cannot go down.
Right.
The company issues the dividend. They give you, here's what we're going to pay you in dividend this year. If you've set it up as we would recommend, all of that portion, 100% of that dividend would go to PUAs, which, just like John said, it's going to increase your cash value and your death benefit. By doing that, you just raise the bar. They can't come back halfway through that next year and go, "Hey, John, I know we gave you that dividend and all, but yeah, we need it back. Sorry."
Not going to
No,
happen.
they can't do that. Once that's raised the bar, that you just set the bar. So imagine, you know, 10, 20, 30 years of constantly raising the bar every single year. I mean, we're talking about the eighth wonder of the world, right? Just the uninterrupted compound growth.
And uninterrupted is the key word you just said right there. Compounding growth is awesome, and we get that in the marketplace. But here, it's uninterrupted.
That's
You
right.
never start the next year at a lower point than you began or you ended the year prior, ever.
That's right.
So, and you're doing that possibly with a max loan out against the contract.
That's right.
So it's pretty incredible.
I
Something
just want to
else.
do the
Sure.
quick recap because you talked about the different options on the dividends.
Yep.
I just want to
Yep.
make sure we're clear on those. So if you set it up the way we would recommend setting it up where your dividend purchases PUAs.
Right.
Your other options are to have that dividend pay your future premiums. Your other option is to receive that dividend in cash. Or the last option, or the fourth option, would be to allow the insurance company to hold that money for you in an interest bearing account. Again, kind of like having a high yield savings. So I just wanted to recap those four options for dividends. Is there any other that I'm missing or forgetting?
Did you say repay a policy loan?
I did not say that.
That was
Thank you.
that's the fifth one. No, I think
Yep.
you got them all, and that was just it's another option that people don't think about. But you could use it to pay a policy loan, and frankly, if you have no other options at that point in time, that's a good option. But as you and I have discussed so many times, this thing is an engine, and if you feed that engine, it gets more and more powerful. That jet fuel just that'll take off. And
Regardless of when it happens, there will be life changes. It's
yes,
guaranteed. And we're
yes,
dealing in whole life products. We're
right.
talking about as long as you're alive, this contract is in force. Now, that doesn't mean as long as you're alive, you're paying premium, but as long as you're alive, this contract is in force. It's guaranteed. If you go over the course of 30 years, there will be life changes. Whatever
Mhm.
that is, could be goods, could be bads. I
Yes.
say that because there's a lot of flexibility that's built into these right off the start. You don't have to call them up and beg to have this faucet changed over into cash. Maybe
Right.
that's what works for you. John and I were encouraged, hey, make sure you involve a practitioner, have a conversation. If big changes like that are happening, just have a conversation. Make sure that all options have been expunged before you make a big drastic change in a policy. Yet the flexibility is there.
Yes. The other item, I don't want to get into this whole other topic, but
Sure.
it does impact some of the flows in and out of the contract. If a contract obviously were to mech, if a
Yes.
contract becomes a modified endowment contract, anything that comes out of there would become a taxable event. And so
That's right.
that if you're over 59 and a half, it's a taxable event at ordinary income. If you're under 59 and a half, it's ordinary income and a 10% penalty. So it can be
Yes.
hefty. And so
Yep.
people need to understand that all this stuff, Jared and I, we explain to people when we do this. But that's also a very important consideration for people too. One clarification, your basis never changes. That's fixed.
Yes.
It's basis plus new additions of new money. So
Yes.
when you're looking today or looking 20 years down the road, the basis is the same, but it's basis plus additions of new contributions.
If this is set up in a way that you are paying premium and your dividends are purchasing PUAs, every single year, you are not creating a taxable event.
Never.
Now, where it gets fuzzy is where you take that out into how much, and when you deploy the capital you've built. We talk about our Nelson Nash's becoming your own banker. That's what we're here for, right? You are
Right.
building your own warehouse of wealth. You're
Right.
finding a place to store your capital that no one else can touch and that you have control over. They can't tell you, uh, you know, hey, John, thanks for building up all this equity in this house over the course of 20 years. Good job paying your mortgage. I know you said you wanted to get some home equity out.
Yeah.
Oh, yeah, it's COVID. Now, shut down. All that equity unaccessible. That's
Right.
not the case in one of these style life insurance policies.
There is no restrictions on
Yep.
access to your capital inside
Yep.
of these contracts.
So that's even just kind of backing up a little bit as to why. That's why we're using these as your ability to build your warehouse of wealth.
Both Jared and I are steeped in this stuff. We've had outstanding mentors all the way up to include Nelson Nash, and we are have a high degree of confidence that we can help anybody. If you're even thinking about this stuff, I don't know anything about infinite banking, reach out and call us. Reach out, go to the website, flightpathfinancial.com. We've got this podcast, Creating Tailwinds. Jared's done a phenomenal job of distribution of our information through all these channels. Maybe you can hit that, Jared, real quickly.
Yeah, we've got the Flight Path Financial Facebook page that we've created, as well as some other pages throughout a lot of social media outlets, and then just getting the podcast out on any place where podcasts are heard, trying to get that out so that it's available. At the end of the day, it's the ability for someone that doesn't want to reach out to learn about it.
Right.
Maybe you take the time to, go online and buy the book. Maybe you buy the audio version. Maybe you listen to it and it just generates a bunch of questions, but you're like, I feel dumb about this stuff. I want to be a little more educated before I try to have a conversation about this. Well, welcome to me 7 years ago. I felt like an idiot. I had no idea
Me
what I was
too.
looking at. And thank goodness for folks that were able to answer those questions, like John, that helped mentor me to get to where I am today, because I didn't know what I was talking about. I had no clue. You don't get to hear about these products in the mainstream. You don't get to, really see a granular look on what they can offer, what they provide, and all of the protections and risks that you transfer by starting. So, don't. I guess my encouragement is don't be afraid to reach out, even if you get
Yeah.
some answers to questions and you're like, this isn't for me. Hey, no harm, no foul. You made yourself smarter on a topic and you moved on. Good on you. Kudos.
The nice thing to fall back on is regardless what happens in the world, you don't need to pass through the Senate by 60 votes. You don't need to go to the House of Representatives, and you don't need a presidential signature to get your money. If you're a
That's right.
federal worker, you know what I'm talking about.
Yep.
This is a system that allows you to control your capital regardless of the circumstances around you, so you can sleep at night and not have to worry. It builds in a layer of comfort in your life financially, whether you find yourself out of work or maybe a low paycheck or a cyclical business where things are down. This will flatten out your your portfolio and your checking account and all of those places where you go to access money.
Or imagine the place of power that it puts you in, just to go full granular on one of those topics you just said. Maybe you end up without a job, not
Yeah.
frozen. Maybe for whatever reason, whether you chose it or they chose it, you are without a job. Imagine a spot that could carve you out 9 months, 18 months, 24 months of flexibility to now allow you to go pick what that next job looks like. You know, maybe you're in a
Yeah.
spot where you're still plenty of good working years left. You're not going to retire early. You want to go find that next job rather than be forced into the next job for whatever they're going to pay you for whatever you're going to do, that you're on their terms because you have to cover the bills, right? What if you had some flexibility to take 6 to 9 months or longer to make sure you end up exactly where you want to be with the terms on your conditions? Like, the
Excellent
amount of
point.
power, that's such a small, tiny little benefit, but the power you hold there and what you've unlocked, That's life altering.
1 in 4 people during the course of their careers will tap their 401k. They'll do it because if you look at the reasons people take money, it's usually for a hardship loan because you can access that capital.
If you take capital from a 401k, you're not gaining on that portion that you took.
No.
They're going to limit you to 50,000, and that 50,000 that you've taken out is no longer building anything. So you still have to pay it back. Cool. The interest you pay back, you're going to pay to yourself. Little different structure than an insurance contract. Yet that 50,000 you took gained you nothing while it was out, except you went to go deploy it to help out with a hardship. What if you had a system where you could still borrow from that, and those funds that were inside the contract is building a dividend while you deploy that capital to your flexibility need? So the little, that's a common comparison is, why would I need this? I could just borrow from my 401k. Yeah, but is it the most productive? And what's the cost? Along those lines, what happens when you do that? So just, again, these are things that just having a conversation is worthwhile.
Have you ever read the disclosures on a qualified plan front to back? Like, I don't mean to put you on the spot.
I never made it through. I fell asleep trying to read it.
Pages and pages, and it seems like the further you go back, the smaller the print gets. My brother, Tony, who passed away last year, always told me to read prospectuses from the back going forward. He goes, the most important information is always at the back. And that's interesting. And I started doing that. And he was absolutely right. With the products that we work in, the infinite banking concepts loan, it's a sheet of paper online. You just fill it out and say, send me the money. It's as simple as that. There are no hoops, there are no restrictions, and there's no asterisks and double and triple asterisks at the bottom of the page qualifying every last little thing you do. It's your money. It belongs to you. It doesn't belong to the brokerage house. It doesn't belong to the bank. Which in the case of whenever you turn your money over to the bank, that is the case.
That's right.
So
Yep.
control, control, control.
Control it is. Fantastic. Well, thanks for taking the time to chat dividends.
Awesome. Let us know what you think. If you have any additional topics you'd like us to cover in our podcast, questions, please reach out. We'll be more than happy to get those out online and discuss them and answer your questions.
Absolutely. Jared? Until next time, stay warm. Keep those pipes from breaking.
We'll do it. Jared, thanks so much. You have an outstanding day, sir.
Thanks. You too.
Thank you.
We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.